All right, credit basics is the topic of the day. You will need to have your note-taking guide open and ready to take notes. All right, so the first section at the top of your note-taking guide should be answered on this slide. You've got credit is receiving goods or services today, but you must pay that back in the future, plus usually interest. Um, and that is just the basic definition of credit. It could be in the form of a credit card or it could be a loan or other types. And the credit availability depends on, lenders trusting that you will pay back the loan as agreed. So this is the basics of what credit and credit reports are all about. There are many different sources of credit. So we mentioned credit cards and we mentioned loans through your depository institution, your bank, or your credit union. You can also get credit through places like pawn shops, automotive dealerships, the government, insurance agents, or private mortgage companies. So you are mentioning 3 of those credit sources on your note-taking guide. When you borrow, you are spending future income, and this is why it can get you in a lot of trouble if you don't manage it properly. So, right now, you might want a $10,000 loan to buy an automobile, but that loan is going to come with an 8% annual interest rate. And you're going to pay monthly payments on that loan for about 3 years. And so, over the course of the 3 years, of that with that 8% interest rate, you are paying $1,280 just in interest. So for the convenience of being able to have the car now, you are paying extra in the long run. So credit can be an effective tool if it's managed responsibly. The negative is if you do not manage it responsibly, is that it is going to create financial stress, negatively impact the quality of life and your financial well-being if it's not managed responsibly. But the positive long-term benefits that you can expect from using credit responsibly is any of these things here. You can invest in your human capital with an education loan. So yes, you're taking on debt, but hopefully you are making yourself more educated, more trained, better able to get a higher paying job. And so that's where credit is worthwhile, worth it. Purchasing a vehicle to get to and from work. You need a vehicle. There are a lot of variations there. Yes, you could get a fairly lower cost vehicle, something that is reliable but not fancy. Or you could get something that's brand new and more than what you need. And that would be a place where maybe you're not managing your credit responsibly. Having a credit card to securely make online purchases or to have a credit card for emergencies are both ways that you could be receiving long-term benefits from using credit. You want to ask yourself anytime you are thinking of getting some type of credit is, does that provide long-term benefits? Is the item that I'm wanting to purchase a want or a need? And even if the loan provides long-term benefits, the credit terms go away, should still be favorable. And we'll talk more about credit terms coming up. Okay, second page. Um, if you um, are thinking of taking out some type of credit to purchase an item, you want to consider whether or not you maybe already have the money to pay for it without going into debt. Do you have money in a saving or investment account? Is that going to be a better option? Or could you wait to purchase the item until you have enough money saved? So some benefits to using money that you already have or money that you save up is that you're not going to be locked into any kind of contract. There's not going to be any interest or fees that you're going to have to pay in addition to the price of the item. and you are not spending future income in this way. The disadvantage would be that it is reducing the amount that you have invested or in savings. So, whenever you are applying for any type of credit, there's going to be a contract that you will sign, and it is important to evaluate that contract and make sure that you understand what's going to happen and make sure that it's a good deal for you. So, here are some things that you might want to look at. Are the terms, such as the interest rate, favorable? Is it a good interest rate? Or are they taking advantage of you? Is the loan feasible both in the present and the future? Meaning, whatever the monthly payment is going to be, is that something that you can handle now and you expect to be able to handle it in the future? And are the terms consistent for the life of the loan? Is the interest rate going to change later on? That's usually not a good sign, but you definitely want to know about it ahead of time. Maybe it sounds great that right now you have a 0% interest, but after a year, that's going to go up to like 26%. So you got to make sure that you're aware of that and know that you have a plan for paying it off before that interest rate jumps. So the recommended amount that you borrow is less than 20% of your annual net income. So if you make $20,000 a year, you want to make sure that the total amount that you have in any kind of loans or debt is 20% of that and not more. And your monthly payment should be less than 10% of your monthly net income. Remember, net income means the amount after taxes, so the take home pay amount. You want to make sure that you are not overextending yourself. You're not obligating yourself into making high payments every month and then barely having enough money for all the other things that you need to pay for. And housing payments, just to be clear, are not included as part of that monthly 10%. So when we're talking about these figures on this page, we're talking about auto loans, um, credit card debt in general, any other kind of loans, education loans, all that stuff, but not home loans. Types of credit. So first of all, closed-end credit, also known as installment credit. This is a loan that you repay a certain amount every month in a certain number of payments. So, whenever you get an auto loan, that's the way it is. Maybe you're getting the loan for 5 years or 3 years or whatever you're getting, and you're paying $200 a month. That's the way it's going to be until you pay it off, right? Features of closed-end installment credit are that the contract is going to outline those repayment terms. It's going to be very specific, and you're going to know exactly what you're getting into ahead of time. Examples of installment credit would be your mortgage loan, your house loan, automobile loans, any other kind of personal loan that you might take out, or a student loan. So, an example, really quickly, is if Toby applied for a $10,000 automobile loan at 8%, he's going to sign a contract to pay $313.36 per month for 36 months to repay the loan. So, every single month, it's the same exact amount. He could pay more than that amount to pay off the loan earlier, but he has to pay at least $313.36 per month. That is just a simple explanation of how it works. Open-end credit, on the other hand, this is also known as revolving credit, and this is where you're extended a line of credit that's established in advance. So, an example here would be a credit card. They offer you a credit card and they say that your maximum um, balance, what do they call it? I can't think of the word, but maximum that you can charge on that credit card would be, let's say, $1,000. And so they have established the line in advance. They've told you you can spend up to $1,000, but you don't have you don't have a monthly payment that's exactly the same every month. It depends on if you've charged anything on the card or if you haven't, or if you've got a lot on the card and you can't pay it all off the very next month, then you're going to pay what we call a minimum payment on that card. They're going to tell you, okay, this month, based on what you owe on the credit card, you have to pay at least $106. And so then if you have the money, you can pay more than $106, but you have to pay at least that much. And usually it is monthly that you are paying for those bills. An example here is if you charge $200 to your credit card and there is a 13% interest rate on that card, you're going to receive a credit card bill and it's going to say you have a $20 minimum payment. So you have a lot of options here. You can pay all the $200 right now, and then your monthly payment from now on will be zero unless you charge more on that card. You can um, try to divide up how much you owe on that card into, say, 6 months, and you could just dedicate your finances in that way to pay that much, 34.61 every month, so that you have it paid off in 6 months. Or you could continue to pay the monthly minimum payment of $20, and it's just going to take you longer in that way. Or in this case, you could fluctuate it. You could pay $20 on months when you can only pay $20, and on months when you can afford more, you can pay more. The point is to pay it off. Otherwise, you are continuing to accrue interest on that amount, and whatever it was that you had to buy, you're ending up paying way more for that item because of all the interest. All right, third page, alternative credit. Right. So there are several types of alternative credit that we'll talk about. These might combine elements of closed and open-end credit. Usually, these are going to have higher, and I would say much higher interest rates, and they usually have higher fees. These are places that you want to try to avoid at all costs because they are taking advantage of your um, desperation, and they're going to really just suck you dry. So that is not, these are things that you want to avoid at all possible, at all costs, but you do want to know that they are out there. So if you get in a place, and this is the only way that you can get credit, you're at least aware of them and you're going to understand how they work. So, alternative credit. Oh, this is payday loan. Sorry. So, yes, it says it huge right there. Why didn't I see it? Payday loan is a short term loan that provides immediate cash by securing a borrower's written check or automatic withdrawal form. So, this is you're giving them your paycheck and they are giving you money now. So it's like for the future. You need money now. They are going to give you money now, but then when you get your paycheck, you're signing it over to them, or they're going to get an automatic withdrawal from your bank on payday. So it's like an advance on your paycheck. So say that you have a loan for $350. The lender fees are going to be $60. The amount that you receive will be $290. So you're getting $290 because you really have to have it. You're paying another $60 to the company. And so your total loan right now is $350. You've already spent more than you needed, right? On the agreed upon date, which is usually your payday, they're going to come after you and they're going to get your paycheck or withdraw money from your account so that they have their money. If you don't have the money in your account, this is where it gets really bad. You're going to accumulate more fees or possible legal action. Possibly they are going to sue you now for the money that you owe them. Or you might just have to pay that $60 fee again to keep the existing loan or to take out a new loan. So once you get this ball rolling, it just keeps rolling and it is not fun. Don't do it. Rent to own. This is typically for like furniture or appliances for your home. You are leasing a tangible item, meaning stuff, with the condition that you, the renter, will own the item if you complete the rental term. So, for example, you want to purchase a 50-inch LCD TV valued at, wow, these are outdated prices, $1,800. You're going to pay $39.99 per week for 104 weeks. Oops, had to cough. So it doesn't sound so bad when you say 39.99, but for 104 weeks, you are paying that amount. Total paid on this item is $4,158.96. You have paid 92% interest. Those are not good deals. If you want to rent something for a party, rent it for a month or two, that's one thing. But if you are thinking that rent to own is a good deal, it is a bad deal. Bad deal. All right. So the next two, title loan and pawn loan, are both on this one because they are very similar. So a title loan is where the borrower, you give the lender the title to your automobile in exchange for some cash. The lender is going to hold that title until you repay the loan. And if you don't repay the loan, they keep the title. So now they own your vehicle. So pawns work the same. Pawn loans work the same, except that we're not talking about a vehicle in this case. It's just some item of personal property. It could be a piece of jewelry, it could be a gun, it could be anything else that holds some value. So you're going to take that to the pawn shop and they're going to offer you some cash for it. And then they're going to keep that item in the meantime until you can pay back the cash, usually with interest or fees, and then you can have your item back. And if you don't pay it back, they have the item for good now, and then they can sell it and make money on it. None of that is really in your best interest. I hope you understand that. The last one here is a refund anticipation loan. So this is like for tax refunds, you're expecting that you're going to get $1,000 back on your tax refund. And so you get a loan for that amount in anticipation of getting your tax refund. Um, the lender, whoever you go to, is going to charge you a fee for this service, obviously. And then instead of you getting your tax refund, you're authorizing your tax refund to go directly to this lender. And if your refund happens to end up less than what they loaned you, then you're going to owe the lender the difference. So, um, other than the fact that you are still owing more money, you're still paying more money for the amount that you're borrowing because of fees and possible interest. This is, I don't know, probably the safest one, I suppose, but it's still a bad idea. It's just a bad idea in general to try to borrow money from the future because future you may not be any more financially well off than current you. So who says that in the future you're going to have the money and everything's going to be great? It's not. Try your best to take care of your issues uh, without going into debt. That's what you need to do. Use debt to help you get better, not just to get you out of a jam, because usually it just gets worse if you try to do that. All right, so how do you get credit if you decided that you need it for some reason? So you will fill out a credit application, and that definition is here. It is a form that's just requesting information about you. Information included on that credit application, they're going to ask you some personal information, how much credit you're requesting, and information about your ability to repay the credit. So usually they're going to want to know, do you have a job? How much money do you make? They want to verify that. They might ask how much money you have in checking accounts and savings accounts and things like that. And then they're going to do a credit check. And that is where they're going to evaluate your credit report and score. And if you happen to have no credit history, um, that usually means that you're going to end up paying higher rates and higher fees. They can't gauge whether you're a responsible person if you have no credit. If you have some credit and it's good, then that is obviously the best thing. If you have some credit and it's bad, then they're probably either not going to give you the loan or they are going to charge you much, much higher interest rates and fees because they are taking a big gamble on you. So, we'll talk soon about how to build your credit responsibly from age 18. It is also important that you shop around for credit. Don't just apply for the first credit card application that comes in the mail. Don't just go to the first bank that you see. You want to shop around and see what different places can offer you. Who's got a good interest rate? Who's got better fees? Does anybody offer a little bit more lenience on missed payments or late payments? If the loan is not paid back in full, what are they going to do to you? And therefore, who has the lower consequences? And you want to make sure that you're comfortable with the lender. Um, if you are shopping around, however, and you decide that you want to apply for a loan at multiple places, remember that they are all going to pull your credit history. They're all going to check your credit. So if you are shopping around for the same type of loan within a 14-day period, there's no impact to your credit score. But if you go apply for a loan now, and then you apply for another one in a week, and you apply for another one in a week, and another one in a week, just how many times people are pulling your credit is going to bring your credit score down. So you want to avoid that. Thanks, guys.